Most traders can mark an order block on a chart, but very few can explain why that exact candle becomes an order block. And that's the difference between copying a setup and actually understanding the market. In this episode, we're not just marking an order block. We'll first understand the zone from which the move began. Then I'll show you why this order block is valid. And finally, the confirmation that tells us when it's actually worth trading. So don't skip any part, because if you miss even one step, the entire logic behind this setup starts to fall apart. Let's start with the first mark on this chart, the demand zone. A lot of traders see a rectangle on a chart and immediately think, this is where I should buy. But that's not what a demand zone really means. A demand zone is an area where buyers previously entered the market with enough strength to overpower the sellers. We know this because, after price traded in this area, the market didn't drift higher slowly. It left with strong bullish momentum. That reaction tells us this price area attracted significant buying interest. So why do I mark the zone here? I don't mark it because price touched this area. I mark it because this is the location where the market changed character and buyers gained control. The move away from this area is the evidence that makes it important. Now, where should we draw a demand zone? We don't stretch it across the entire rally. We identify the price area where the buying pressure originated, the base from which the impulsive bullish move began. That's the area we want to monitor if price ever returns. So, what does this zone actually tell us? It tells us that buyers valued this price in the past. If the market comes back here, there's a possibility that buying interest may appear again. But notice the word possibility. A demand zone doesn't predict the future. It highlights an area worth watching. And here's the mistake many beginners make. They place a buy order the moment price touches the zone, assuming it must bounce. Professional traders don't think that way. They let the market reveal whether buyers are actually defending the area again before committing to a trade. So, the demand zone gives us a location. But location alone isn't enough. The next step is to watch what the market does after reaching this area, because that's where the real story begins. Now, pay close attention to what happens after price reaches the demand zone. Instead of moving sideways or struggling to climb, price leaves the zone with a strong bullish displacement. This is an important clue because it shows that buyers entered the market with enough strength to dominate the sellers. A strong displacement isn't just a large candle. It's a move that clearly breaks away from the zone with momentum, leaving very little hesitation behind. That tells us buyers are in control at this stage. This bullish displacement is the reason this area deserves our attention. But even after seeing such a powerful move, our analysis isn't complete yet. In the next step, we'll focus on another important mark that forms because of this displacement. Now let's move to one of the most misunderstood concepts in smart money trading, the order block. Many traders believe that every last bearish candle before a bullish move is an order block. But that's only a small part of the story. If you mark every bearish candle as an order block, your chart will quickly fill with dozens of zones, and most of them will never work. So what makes this candle different? Look at what happens immediately after it. Price doesn't just move higher, it leaves the area with strong bullish displacement. The move is fast, decisive, and shows almost no hesitation. This tells us that buyers entered the market with enough strength to completely dominate the sellers. In many high-quality setups, this displacement also leaves an imbalance, showing that price moved so aggressively it couldn't trade efficiently through every level. While an imbalance isn't the only requirement, it adds confidence that the buying pressure behind the move was genuine. So where do we mark the order block? We don't mark the entire rally. We mark the last bearish candle before the strong bullish displacement begins. That candle becomes the order block because it represents the final area where buyers absorbed selling pressure before driving price higher. Now, what does this order block tell us? It tells us that buyers previously defended this price area and created enough momentum to launch a powerful move. Because of that, if price returns to this area, traders pay close attention to see whether buyers are willing to defend it again. But here's a mistake almost every beginner makes. They treat an order block as an automatic buy signal. It isn't. An order block is an area of interest, not a guaranteed entry. It works best when it aligns with the overall market story, such as liquidity, displacement, and market structure, rather than being traded in isolation. So now we've identified the order block. The next question is, what should we do when price returns to it? That's exactly what we'll cover next. After creating the strong bullish move, price doesn't continue rising forever. Instead, it starts retracing and gradually returns to the order block. This is a completely normal part of market behavior. Markets expand, retrace, and then decide whether the trend should continue. Now, as price reaches the order block, we're not looking for a buy entry yet. At this stage, we're simply observing how price behaves inside this area. The order block tells us where buyers were previously aggressive, but it doesn't guarantee they'll defend the area again. That's why we remain patient. Instead of predicting a reversal, we allow the market to reveal its intention first. In the next step, I'll explain why waiting here can protect you from many false entries. Now comes the part where most beginners make their biggest mistake. The moment price reaches the order block, they enter a buy trade without waiting for any confirmation. But think about it for a second. Just because price has returned to an area where buyers were strong in the past, does that automatically mean they'll be strong again today? The answer is no. That's why we don't rush into the trade. We let price react first and watch whether buyers are actually stepping back into the market. If the market respects the order block, it will leave clear clues that buying pressure is returning. Our goal isn't to be the first person in the trade. Our goal is to enter only after the market gives us enough confidence that our trading idea is valid. And that's exactly the confirmation we'll look for in the next step. Now the confirmation we've been waiting for finally appears. As price reacts from the order block, buyers step back into the market and create a strong bullish displacement. This move is important because it shows that buyers aren't just slowing the decline, they're taking control again with strength. At this point, I don't enter simply because price touched the order block. I enter because the market has now proven that buyers are active again. The bullish displacement is my confirmation that the order block is being respected. Once this confirmation is visible, I take my buy entry. My stop loss goes safely below the recent swing low, because if price breaks below that level, the buying idea is no longer valid. From here, I shift my focus to the next objective, which is the buy-side liquidity. Why? Because liquidity often becomes the destination of a strong move. As long as buyers remain in control, there's a higher probability that price will continue pushing higher to reach that liquidity. Now let's follow the trade and see how it develops. After our buy entry is confirmed, buyers continue driving the market higher and price begins respecting our analysis. This is exactly why we waited for confirmation instead of buying the moment price touched the order block. As the trade develops, price keeps creating higher highs and higher lows, showing that buyers remain in control. At this stage, the best thing a trader can do is stay patient and avoid closing the trade too early just because of small pullbacks. Eventually, price breaks above the internal liquidity and continues moving higher. If you'd like a complete breakdown of internal liquidity, what it is, why it's marked, how to identify it, and how smart money uses it, comment liquidity below, and I'll make a dedicated episode explaining it step by step. Now, let's see if price can continue toward our final target. So this was the complete breakdown of this trading chart. We started by identifying the demand zone, understood the importance of the order block, waited for the bullish displacement confirmation, took the buy entry, and followed the move as price pushed higher. Remember, the power is not in marking more things on your chart. The power is in understanding why each mark exists. If you enjoyed this step-by-step breakdown, comment which concept you want me to explain in episode 3. See you in the next chart breakdown.